Class, I've been asked a few questions about problem number 6 in chapter 3 homework. So let me walk you through the problem. So let me get to number 6. So this is number 6 and it's from problem 3-2A in your textbook. You have A through F adjustments to make in requirement number 1. So the first adjustment is about office supplies. We have the beginning balance of supplies plus additional purchases minus inventory still available. So we take 4,000 plus 13,400 minus what we have left, and it will give us an amount of office supplies used. So in adjusting entry for all prepaid expenses, always debit to an expense. So here it will be office supplies expense and credit to the asset. And the asset account is office supplies. So with this adjustment, we are taking out of the asset called supplies and expensing it out, moving it as an increase or debit into office supplies expense. And the amount is 14,846. Again, this amount is the beginning balance plus purchases minus ending balance. Done. So this is the first one. Second one, or B, it's a very similar adjustment for deferred expenses. Now we're talking about insurance, and here we don't have to really worry much about calculations, but always I teach my students with the adjustments, think about the math first. What is the amount? So here we have beginning balance, and this is how much of insurance is left unexpired. So we need to subtract them. And when we subtract them, we get 7,120. So this is the amount of insurance used up, expired. Debit expense, so it would be insurance expense. Credit asset, here it's prepaid insurance. The expense goes up, the asset decreases. Transaction C has to do with accrued expenses. Expenses that took place, but we will pay cash for them later. Actually, in requirement 2, next year in January, we will pay cash. Now we're just recording an expense that took place. So this is dealing with salaries. For accrued expenses, we always debit an expense, which would be salaries expense. And we credit increase the liability because we owe money, salaries payable, okay? So debit the expense, credit the liability. The amount we have to figure out here is we have 15 employees. In total, all of them earn $1,960. They're paid each Monday. December 31st is a Tuesday. So the end of the year is Tuesday. So we owe money for 2 days, Monday and Tuesday. We take 1960 multiplied by 2 days, and it gives us an answer, 309,920. 3,000 times, 920. By the way, check my work. Looks good so far. All right. So transaction C is done. Let's go to transaction D, and this transaction is about depreciation. So for depreciation, we're always going to debit depreciation expense. We're going to credit a contra asset accumulated depreciation. So it's also a prepaid or deferred expense, debit expense, credit asset. The amount we need to take with you here, the cost. This is the cost, 960,000, minus salvage value, minus 45,000, and divided by 30 years. So they already did the calculation for us. But if they didn't give it to you, you just take cost minus salvage value divided by useful life. Done. Transaction D. Transaction E deals with accrued revenue. So what happens here, a monthly rent is 3,000, started on November. The rent was paid on time for November 1st, and It was credited to the revenue account. However, the tenant has not paid the December rent, so they owe us $3,000 for December. Right now is December 31st, so all these entries we're making, all adjustments are made at the end of the year, at the end of the accounting period, which is December 31st. And so the company has worked out an agreement with the tenant who has promised to pay both December and January rent in full next year. So in requirement number 2, they will pay us $6,000. Right now they owe us $3,000. So this is accounts receivable, or it could be called rent receivable. It's an asset. They owe us money, but we record rent revenue right now. We earn this revenue, but it has not been received. So this is an example of an accrued revenue type of adjustment. Asset up, some kind of receivable, revenue up. And the last transaction deals with here, okay, let's see. So November 1st, the company rented space to another tenant for $2,800 per month. The tenant paid 5 months rent in advance. The payment was recorded with a credit to unearned revenue account. So that happened on November 1st. Today is December 31st. So we have earned 2 months of this 2,800. So this is an example of deferred or unearned revenue. So take 2,800 multiplied by 2 months, November and December, gives you 5,600. That's my math. And we earned it. So I need to decrease the liability account. Unearned revenue is a liability. It's no longer unearned. Goes down, debit, liabilities are minus plus. And we're gonna debit a revenue, credit the revenue account. So this is an example of the unearned or deferred revenue. Liability down, revenue up. Done. So the first requirement is completed. Here are all the transactions. Okay, and the second requirement is the follow-up. What happens in January? Prepare journal entries to record the first subsequent cash transaction in January of the next year for parts C and E. So in C, now in January, so it's going to be January 6th, employees will be paid salaries for 5 days. So this is January 6th. Return to question. Let me go to requirement 2. January 6th, we are paying cash partially 2 days for salaries payable we owed from the previous, let me go right here, from the previous year, from December. So the salaries payable 3920 is paid now. 3920. So that was the amount we owed for 2 days, Monday and Tuesday, because Tuesday was December 31st. Additional 3 days belong to the current year, January, new year. So we take the amount my employees earn, 1960, and we multiply it by 3 days. So 1960 multiplied by 3 days for Wednesday, Thursday, and Friday of the new year gives us a debit of 5,880. But the cash we pay is both of those amounts together, which is 5 days worth of salaries. So you can see how we split the expense for the previous year was recorded and reported in December last year, and the expense for the current year is for 3 days, is reported this year. So we match expenses per year. This is the matching principle of GAAP. Okay? And then the last transaction we talked about, this is related to this E. So now in January, we are receiving cash for 2 months. So 1 month is 3,000, 2 months is 6,000. So we are receiving cash. Let me do this cash. And we're going to credit accounts receivable from last year, which was 3,000. and we're going to credit rent revenue. So same thing like with the previous entry, we match, without regard to cash, we match revenue to the period in which we earned it. 3,000 was reported in December, and we'll go to December's income statement, and 3,000 we are earning for January and reporting it in January. So that's it. This is, let me record it, check my work, and this is so requirement number 2. Hopefully it makes sense. Have fun with the chapter.